While the S&P 500 and NASDAQ closed slightly lower, small caps getting hit hardest. The Russell 2000 seeing its worst day since September, falling nearly 2%. But Bitcoin reversed early losses, briefly traded above 90K. It's up more than 30% since Trump's win. For more on what's next for the markets, let's bring in Tom Michaud, the CEO of KBW, a Stifel company. Tom, always great to see you.
Good evening.
We were just talking in the break about how things have really changed. And so from your standpoint, what is the biggest thing that will change for your industry?
So I think, we've studied the financial services industry. Number one is the fundamentals are getting better, mainly because the yield curve is not inverted anymore. Remember, in the third quarter, we ended the longest yield curve inversion in 47 years. So that has meant that for 2 years, banks had down earnings. The fundamentals are changing. We're now expecting earnings to do very well for the next 2 years because operating leverage is back and the yield curve is not inverted anymore. So that's the fundamental case. And then the other items, which is you no longer, I think, have to deal with an environment which was very aggressive from a regulatory perspective. And I think you're going to have some policy shift. And, hey, you want to look at the market about policy shift. Fannie and Freddie, which still have stocks that trade, the stocks have doubled in a week, and so have the preferreds. So obviously the market thinks there'll be a policy change about housing in the United States with this election. And then you look at a group of stocks, the M&A boutiques. On average, the M&A investment banks are up over 60% year to date, with some of the stocks having doubled. And I think there's a whole idea that you're going to see the capital markets free up now that you don't have a policy, for example, that's been so opposed to M&A in the nation.
You just answered my question. I mean, a lot of these banks, one would think, are M&A targets in this new administration. So I think a lot of the run, not the entirety of the run, but a lot of the run is predicated on that.
So when Congress changed the laws in the mid-'80s to allow interstate banking, it's been consolidation. What's interesting is that many years ago, the thought was the biggest banks were too big. Well, they've gotten bigger. So the 4 big banks have 40% of the deposits. The right thing to do is for these banks to have competition. And rather than allowing no M&A, which means will be frozen in time, and these 4 big banks will get even bigger, you've got companies like PNC, U.S. Bancorp, and others who would like to be competitors or more of a competitor to the big 4, right. And they would like to consolidate, which I think has a lot of logic to it, but if done right.
And you talk about the yield curves, now the bank's friend. But how about the current environment? We talked about this great rally, but how about if rates keep backing up the way they are? You've got a lot of banks that have rallied that are they're liability-sensitive names, and the world was pricing in all kinds of rate cuts. I mean, and yet these things have rallied even while rates have reversed and gone higher, and rates could go higher. So, at what point are these trades off sides? Because some of them really are vulnerable and sensitive to higher rates, and yet they're not responding at all right here.
Yeah. So, look, our base case is that we get a December rate cut, and then we're going to get a 25 basis point rate cut every other meeting next year. That's what's in our base case. That leads us to believe we have 8% earnings per share growth next year, followed by 12% earnings per share growth the year after. Things that you mentioned, if it's a different pace, that may change that. But I'll also tell you, we have very low loan growth in our model. We have 4% loan growth. The reality is I think if there's a surprise, we may get more loan growth. If that happens, that would offset some of that rate differential, in our opinion, in my opinion.
You mentioned before in our conversation during the break that maybe banks will take a breather. I mean, it's been a really just torrid run since the election. But how do you know when to get in? I mean, if you've been on the sidelines, and a lot of people have, a lot of people de-risked before the election. They wanted to stand to the side.
Well, so there are a couple of ETFs you could play. So the Keefe Bank Index Large Cap Bank, that's the KBWB, or the Keefe Bank Regional Index, which is the KBWR, are 2 ETFs that you could buy. I would prefer the regional banks, because I think they're going to benefit more from the shape of the yield curve. But you could play these ETFs. But there still are ideas. So 2 of our favorites, number one is we like Truist, one of the biggest banks in the nation, 4.6 dividend yield, really positive. You get paid to wait. Trades at 9 times 25 earnings. One day they could trade at 12 times earnings, in my opinion. Webster Financial is a similar company trading at a single-digit multiple relative to 2025 earnings. So these are some of the stocks. So there are still stocks we think you can pick. But I wouldn't be surprised if we caught our breath because it's been so strong. But maybe if that happens, it's a chance to start your position.
Tom, it's always great to see you. Come by anytime.
Well, great to be with you.
KBW.